Morning, everybody. Welcome to the Livestock and Dairy session overview. My name is James Morin. I'm the owner and operator of Kipling Ridge Farms in Ontario, Canada. We're a regenerative farm that raises livestock, primarily beef cattle, hogs, and poultry, all for direct sales in our local markets. I'm joined today by a couple of colleagues. I'll have them each briefly introduce themselves. We'll start with you, Erik, because I see you here on my screen first. Go ahead.
Hi, it's Erik Leach here. We're in the Ottawa Valley in Ontario, Canada. It's my wife and I operate a regenerative dairy operation, and we're moving into the processing and marketing as well as our dairy products. So we're excited to join everybody here today, and let's see what we can do.
That's great. Thanks, Erik. And we also have Chandrasekharan from the FAIRR initiative. Tara?
Hi, everyone. I'm Chandrasekharan, and I'm an ESG analyst at the FAIRR initiative. And we are an investor coalition focused on ESG risks in protein supply chains. So one of my focus areas of research has been on the New Zealand dairy industry. So I'll be sharing a bit about the impact of carbon pricing in the dairy industry in New Zealand.
Great, thanks, Tara. And on that, let's jump right into that particular topic. So I'm going to share my screen with a couple of graphs, if that's how you'd like me to get this started, Tara. And I'll simply, I'll let you take it from there, and then Erik and I will jump in afterwards. So just give me a moment here. And Tara, just let me know if I need to jump forward through your particular slides once I've done the screen share.
That sounds good. Thank you, James. So today I'll be talking about the potential impact of a carbon price on the livestock sector, looking at New Zealand's dairy sector as a case study. And I'll be talking about the impacts on profitability to the sector and how the price and the broader climate goals of New Zealand will incentivize a shift away from dairy. And then finally, I'll be discussing how these risks will be compounded by the growth of plant-based substitution. So in 2019, New Zealand passed its Zero Carbon Amendment Act, aiming to produce net zero emissions by 2050. And the act includes a separate target for biogenic methane, aiming for 10% reduction by 2030 relative to 2017, and 24 to 47% reduction by 2050 relative to 2017. And as part of the strategy to achieve these targets, the government and the agriculture sector are in the process of designing a price on agriculture. And the pricing scheme will be introduced by 2025 and could be introduced as early as next year. So it's likely that any price will begin with a free allocation, meaning that a certain proportion of emissions will not be priced to avoid sudden disruption to the sector. And estimates indicate that the amount of initial free allocation would be around 90 to 95%, meaning that only 5 to 10% of emissions will actually be priced in the beginning. And the free allocation will likely be phased out over time. So James, if you could go on to the next slide, please. Great, thank you. When we were doing this research, we looked at what this might mean for the sector. So focusing on 3 impacts, including the impact on cost to the sector, how it might exacerbate debt, and drive diversification away from a pure dairy model. So from our models, it's clear that the carbon price will impact the profitability of the dairy sector as the carbon price increases and the free allocation amount decreases. Our models, just to flag, our models only include the impact of the carbon price and do not include the costs associated with measurement, mitigation, and or the physical impacts of climate change, including higher disease incidence and mortality and lower yields for dairy cows. So we used forecast carbon prices on biological emissions published by New Zealand's Parliamentary Commissioner for the Environment. And under a scenario of a 50% target reduction, which is the closest forecast price to the upper boundary of the government's actual target, carbon prices could be up to 26% of the current average operating profit of owner-operator farms by 2050, as shown in this graph. And owner-operator farms make up the majority of dairy farms in New Zealand. And similarly, for Fonterra, the largest dairy producer in New Zealand and the world's largest exporter of dairy, carbon costs could amount to up to 87% of EBITDA by 2050 under the 50% reduction scenario. And Fonterra has used a similar calculation to what we used in its own analysis, but they've only done the analysis up to 2030 and we've used sort of slightly different assumptions. So in addition to the increased carbon costs, this will also exacerbate the existing issue of high debt levels faced by New Zealand's dairy sector. So in New Zealand, dairy farm debt is among the highest, and this has been flagged by the Reserve Bank of New Zealand. And the high level of dairy debt has been driven mainly by the dairy price downturns that have occurred in the past decade. So compared to other agricultural sectors, the proportion of non-performing and potentially stressed loans is significantly higher in the dairy sector. So it makes up 11% of loans in the dairy sector versus just 6% in other forms of agriculture in New Zealand. So increasingly, banks are becoming hesitant to provide new lending to the sector, in part due to cost compliance concerns with new environmental regulation, including the incoming carbon price and existing legislation around water quality. And this has been evident by the slowing growth rate of credit to the dairy sector since 2015. In contrast, credit to the horticulture sector has been rising, led by the kiwi sector, where credit lending is growing at an annual rate of 15%. So James, if you wouldn't mind going on to the next slide, please. Thank you. So as costs associated with the climate transition rise and bank lending tightens, the incentive to diversify away from pure livestock production towards horticulture and exotic forestry will increase. So in its 2021 draft consultation published in February, the Climate Change Commission projected that meeting the lower end of New Zealand's methane target will require both dairy production and dairy land use to fall. So this graph shows that dairy land is expected to have to fall by 4% relative to 2018 by 2035. And we would also need to see land use for horticulture and exotic forestry to increase by 23% to meet these targets. So as the carbon price is one of the tools that have been proposed to help achieve New Zealand's climate goals, the price will also be used to drive this shift. And although it's still being designed, it's already clear that the price will reward farmers for sequestering carbon. So this will incentivize farmers to diversify away from purely emissions-intensive forms of production to alternative land uses like forestry and horticulture that will allow them to benefit from the scheme, effectively resulting in an alternative income stream. And already sheep farmers in certain parts of the country have found it more profitable to shift towards forestry rather than purely sheep. Obviously, this depends on the type of land and things like that. So, yeah. And in addition to the risks of climate-related regulatory risks, these risks will be compounded by the threat of plant-based substitution. So in 2019, plant-based dairy made up 12% of the global dairy market, and we're seeing continued growth in demand for plant-based dairy in New Zealand's largest export market, China, and other key markets, including New Zealand and Australia. So in China, the plant-based beverages are expected to reach a compound annual growth rate of 2.7% between 2019 and 2024. And in New Zealand and Australia, 1 in 3 people are reducing their meat consumption. So these are some of the trends that we're seeing around plant-based substitution. And if you wouldn't mind going on to the next slide, please, James. Thank you. So there are a number of ways that companies can address the potential risks associated with a carbon price and turn it into an opportunity, including shifting to low carbon production methods and increasing their product and portfolio level diversification by investing in alternative proteins. So although the reality of these risks are materializing in New Zealand already, this is not a uniquely New Zealand issue. So this graph, I think because it's on Keynote, perhaps some elements of the graph are missing, but that's all right. I'll just go on. So this graph shows that is meant to show that among the top dairy producing countries, New Zealand's emissions intensity is relatively low, although it's not the lowest. So I think the US, France, and Russia have lower emissions intensity than New Zealand, but in some of these, just to flag, in some of these regions that are more efficient, it may come at the expense of animal welfare. As carbon targets are set and carbon price coverages increases, decarbonizing in less efficient regions will be even more challenging. And in the context of its climate goals, New Zealand's dairy sector and its companies like Fonterra can claim a first mover advantage by making the shift to a low carbon portfolio. Thank you. That was my presentation. James, you're on mute. Sorry.
Thank you so much, Sarah. It's really interesting. I've seen a lot of this information across the world, so it's nice to have some very specific stuff. New Zealand's such a special case, just given the nature of their location and such a long historical record of pastoral-based, livestock, whether it's dairy or raising it for meat, and we're definitely seeing that in other regions, and I think it presents both challenges and opportunities related to whether it's carbon pricing and or just simply a shift in production practices. And Erik, I'd really like to get your thoughts on that, on sort of, as a dairy producer. There's just as someone who's familiar with your operation and the industry, of course, here in Canada, I'd really like to get your thoughts on the challenges and opportunities as a producer. And just please elaborate on that.
So our biggest challenge we face now is that we have a product that's produced on a large commodity-based scale, and a lot of those practices have been imported from large dairy producing countries. We produce under domestic market. We don't produce for export. However, a lot of the practices that have been promoted and incentivized have been for volume production. And we're seeing a lot of the similar issues in regards to customer ability to identify with some of the domestic production practices. There seems to be a disconnect with what we do domestically versus what happens on a commodity produced scale in other countries. So what we're seeing is we're starting to see a drop in consumption. We're starting to see consumers look for alternatives, and we're having to play catch up and try and help the consumer understand what our production practices are. And we haven't been able to do a good job at that. So we're having to branch out on our own as our own dairy farm and start doing some of these regenerative practices that we can communicate transparently to consumers to help them understand what we're doing, that we're producing a domestic product that doesn't necessarily have to take into account some of these larger projects that are available out there that Tara was more speaking about. We can produce an ecologically. We can show our ecological stewardship very transparently and be able to identify some of those values that consumers certainly now have. So things such as pasture barn setups, feeding fodder, some of those things that we can do in Canada that allow us to meet some of these ecological stewardship goals that the consumer has for dairy, to keep them drinking milk and buying cheese and understanding our business a little better.
That's great, Erik, and I'll chime in now, sort of from the livestock side, given that that's what I do, and literally all of that stuff that was in Tara's report with respect to dairy applies to whether it's beef, pork, poultry. Beef tends to get most of the sort of the bad rap with respect to current production practices, and it's well deserved. But the reality is, the last statistics that I have, pork is the most consumed meat in the world, and the vast majority of that is raised in very carbon intensive ways, from feed production to how the animals are managed. And I see that as a huge opportunity. Many of us, I think, the alternatives that you were mentioning, Erik, are certainly gaining more steam in the dairy side, which is perhaps just has to do with product development from a research and marketing standpoint, maybe a little more straightforward than the alternative sort of meat and protein space. But the opportunity in my mind, what gets lost in a lot of the media you see around these alternative meats is the fact that the traditional meat industry is growing at a greater pace on an annual basis than the entire alternative protein industry right now. Now that's bound to change as the products become more accessible to the end consumers from a pricing standpoint and a quality standpoint. But at the same time, it still, in my mind, presents a tremendous opportunity to shift how we're producing livestock on a global scale, and we're showing that it works economically and ecologically, and we're certainly not alone. And it's happening all around the globe. That they're from both aspects of how the livestock itself is managed, to how the feed is grown. For when we're talking about ruminants, of course, we're looking at not necessarily supplementing anything outside of their natural grazing habits. But again, referring back to, say, pork and poultry, supplementary feed is still necessary, but it doesn't mean that can't be grown in a regenerative way. Much like you mentioned, Erik, the distribution and marketing side is a challenge because the current systems are, on a global basis, are really set up for large scale efficient operations in processing and distribution when it comes to meat. And again, in my mind, therein lies the opportunity of rebuilding local and regional supply and distribution chains. Where the challenge there, of course, is these are, whether on a small or large scale, incredibly capital intensive businesses. If you're talking even putting up a small processing plant, you're into multiple millions of dollars on a US dollar basis. So it's interesting to see what's so similar in these two particular industries around livestock, both from a research perspective and from an opportunity perspective. Tara, I was wondering, some of the other research I've seen from FAIRR, if you can kind of elaborate on some of the I don't want to call them threats to demand, but we're seeing, I remember seeing a report on your site that had to do with the meat tax, which is as impactful potentially as a carbon tax on emissions. And I understand if you're not intimately familiar with every report that your institution puts out, but would you care to comment or elaborate on that at all?
Yeah, thanks for that question, James. I mean, I think with our meat tax report, one of the examples that was included was looking at this carbon tax in New Zealand. So the meat tax report essentially looks at proposed carbon taxes on agriculture, because right now, compared to other sectors like the power sector and the manufacturing sector, it's not one that's facing a similar sort of carbon tax just yet. So I think the proposed tax in New Zealand is going to be one of the first of its kind, and it's going to be a really well, the way it pans out will be really interesting to see in terms of how the sector will have to respond, and what sort of cost implications that will mean to the sector. But yes, as you say, I'm not completely familiar with the exact details of the report, but I know it's sort of just framing that this will be a potential threat to the sector, and I guess the example that I talked about is one of the key ones there.
Perfect, thanks. Erik, a little bit of a different idea. I'd just like to get your sense of, we talked about challenges and opportunities, and you and I have had conversations personally about what opportunities are there. Can you give me a few quick words around what it would take for you to kind of realize, your vision for either, your farm itself, but also on a sort of a bigger scale? What's missing?
Well, I think all the components are there. I think we have a market that's ready for regenerative agriculture. We have some push from legislation from higher bodies that are trying to help us get into servicing the customer and filling the market here domestically, which is what we're after. We're not after large commodity production. We're looking at a small segment of the market. There are some mechanisms that are a little, how we should say, slower to bring together to get out of the way. I think there's some idea that these regenerative practices are a threat to commodities, as to what we can do in the message that we're delivering. However, I think to answer your question, at the end of the day, what's the bigger picture? What can get out of the way? I think I really think delivering some of these big, sexy ideas from the top down are going to be advantageous to some of the smaller producers, because what we've seen in the past is some of these big, sexy ideas that are being pushed forward are actually consolidating commodities, and you're seeing these management practices go the exact opposite of ecological stewardship. So in that push forward for a greater top-down incentive building, we're going to see more room, I think, for transparency in the local market and the domestic market in order to produce an ecologically sound, transparent product.
That's great, Erik. I would agree too. And again, it's amazing how I don't have a full understanding of the sort of, I guess, the dairy value chain, but it seems so similar to what we're seeing on the livestock side as well, that there's a demand for the type of product that we're raising. Scalability is an issue, and it's certainly that's what is holding us back right now. I happen to have a background in commercial finance, and that is a key missing component just in how finance is structured for certain types of farms. And so, but I'm excited by both, like what you said, there's some top-down incentives coming. I see it all around the globe of how these can be done, but also a lot of innovative financing models are coming out from some very forward-thinking institutions, groups, and individuals as well. So,
if I could, James.
Oh yes, of course.
If I could, yep. James, I'd like to point to one of Tara's notes that she made, and that's very important. That the financing for these operations, no matter how big or small, is becoming a lot more constrained. I mean, some of my personal war stories, I mean, I won't share here, but it's, if you're painting a picture to current lending institutions as to what you want to do, projecting going forward, and they don't have any benchmarks to rely on, they're already hesitant in the future, and they're already hesitant to begin with in this sector. And to paint a picture for them of ecological stewardship, they just don't have the background or understanding as to how to finance these changes, let alone finance the current operation or how it's going to go forward. So there's a big gap there that we need to cover, and I'm glad Tara brought that information forward.
Yeah,
100%. Sorry, go ahead, Tara.
I was just going to say there are some interesting examples in New Zealand of financing mechanisms coming up to link credit lending to sustainability linked goals. So I think like with ANZ Bank and also the Bank of New Zealand, they've recently issued sustainability linked loans to some large dairy companies, and I know with the loan that was given to Southern Pastures just in March of this year, they've sort of linked the loans of the terms of the loan to meeting certain carbon targets, to meeting certain biodiversity related targets, and then based on if those targets are met, the cost of the loan will decrease year on year. So this is will address some of that farmer debt issue in New Zealand, where it's such a big issue, and incentivize farmers to shift their production models and adopt some of those sustainable practices. So it's great to see that sort of thing emerging in New Zealand.
Absolutely, and that's happening elsewhere too, Tara. It's and it's interesting. You've both just given sort of both sides of that particular equation. And again, as a commercial lender, I can 100% agree with what Erik is saying, at least in sort of the traditional space. And it's just, I won't say it's not on the radar, but it's very difficult to adjust risk models to take into account a lot of these ideas and concepts that just don't have those benchmarks. And from the other side, at the same time, like I said, there are some forward-thinking institutions that are really, starting to put these types of financing in place. So I remain optimistic. We do have to allow some time for some Q&A as we're running up against our limit here. So the first questions come in. And I'm not sure if you guys can't see it, I'll read it out anyways. Do you see any concerns regarding the focus on emission intensity? Do investors set a priority on total emission reductions and not only on a per production unit basis?
I'm happy to
go ahead, Tara. Let me think about that.
Yeah, so I guess at FAIRR, one of our largest research projects is called the Protein Producer Index, where we evaluate several large meat, dairy, and aquaculture companies. And one of the things that we look at is emissions intensity and versus absolute emissions. So definitely there is a concern on focusing on emissions intensity rather than absolute emissions, because then they can improve emissions intensity, but the absolute emissions can go up at the same time. And only reporting on emissions intensity is a way of sort of masking that. So in our assessment, we do in our assessment that we have developed in collaboration with our investors and companies, we do award companies more points for reporting on improvements in absolute emissions rather than emissions intensity. So it's definitely a priority that we're seeing from the investor community. Yeah.
Thanks. I won't add anything to that. Go ahead. Go ahead, Erik.
The only thing I'd say is that we don't have the administrative force behind us in order to do to calculate these things. We're looking at putting an ecologically sound product on the market for consumers to understand, and that's what we're going towards. And I think consumers are voters, and if they understand that their food and they have a choice to consume some dairy products that are from a farm that's that they understand, that's transparent, and we meet certain goals, then I think they'll make that choice. And we don't know what the commodity producers will do or what how they'll be able to measure these things.
Yeah, that's great, and it is. I think there's challenges on both sides there. So I don't mean both sides, but I mean relative to size, whether it's dairy or livestock, that there's a lot of work happening on the small scale, and you're right, there are constraints when it comes to what can be tracked and measured when just getting the production and marketing done is 2 full-time jobs for what is in many cases a single individual or a small family trying to run an operation. So that does need to be addressed as well, because you said a key word there, and it's transparency. And in order for initiatives like this to scale, I think that's critically important. So yeah, we've got, I just got my warning. We've got the final few minutes here. I'm not seeing any other questions yet, but if either of you had any sort of final thoughts or comments, please go ahead.
Well, I'd just like to say there's great opportunity in this sector for growth. The market's there, and we need some smart people on board to help us get there, to get to scale. James and I, one of our conversations is just imagine the volume that you have to produce in order to meet these markets and understand the size of the business. There's a reason that these economies of scale have sized so quickly in the last 20 years, and the amount of money and energy that have gone into the research in order for these businesses to expand and consolidate and get to those sizes. The capital investment required is massive. But that doesn't mean we can get there in incremental steps. And I think what we're trying to do can be copied the world over. We can do these things on a small scale and grow bigger. And there's a lot of opportunities. We just need to bring the right people into the fold and help us get there. I think there's some solutions there that are very, very plausible to move forward from the bottom up, and maybe we'll meet in the middle somewhere.
That's terrific, Erik. Tara, any final thoughts?
Yeah, not much else to add on to that. Agree with Erik's point around sort of building these models that can be replicated in other regions. And I think, yeah, companies like Fonterra have the advantage to take that lead. And I think they are also sort of discussing adopting a regenerative mindset and embedding things like agroforestry into their models. So yeah, hopefully we can see that scaled up in other dairy producing areas as well. But, yeah.
Well, that's great, folks. Tara, Erik, I'd like to thank you both very much for joining us this morning. As we over here in Canada get off to our busy day of chores. It was an interesting start to the morning, and I wish you both the best, and have a great day, everybody.
Great. Thanks, James. Appreciate it. Very grateful.
Thank you, James. Thank you, Erik.